All right. Thank you all for joining us this morning for the second day of our second FC Build conference. Since many of you in the audience are new to FC Build, let me start with a very short introduction to Foundation Capital. So Foundation was founded in 1995. We're an early stage venture firm managing $4 billion in capital, and more than 30 of our companies have gone public over the years. We've backed some pretty extraordinary entrepreneurs over the last 2.5 decades. And in our enterprise practice, we've been fortunate to partner with founders in enterprise infrastructure up and down the stack. So from cloud, data, AI, automation, and DevOps, as well as B2B SaaS and cybersecurity. We primarily lead seeds and Series A's, usually before a company has any revenue or even a product. Basically, we invest in extraordinary dreamers with extraordinary dreams and work with them to make it real. So speaking of extraordinary dreamers, please allow me to introduce you to our speaker, Henry Ward. By way of background, Henry Ward was co-founder and CEO, or is co-founder and CEO of Carta, software platform to help private companies and their investors manage their cap tables, valuations, portfolio investments, equity plans, and more recently, secondary sales. We'll talk a bit about that. So since its inception in 2012, Carta has managed hundreds of billions of dollars in equity for more than 1 million employees and investors at more than 23,000 companies. Before Carta, Henry was founder and CEO of Second Sight, a portfolio optimization platform, and he's also held leadership positions at Redworks and Between Markets. So with that behind us, Henry, welcome. I'd love to kick things off with a very quick bounce on the eShares Carta origin story. You had this sort of vision for NASDAQ for startups, and I'd love for you to kind of ground us in that original beginning.
Yeah, sure. It really came out of Second Sight, which was an abject failure. It completely died. It was a robo-advisor like Betterment or Wealthfront, but John Stein and Andy Radcliffe did such a better job than I did, and so my version of it died on the vine. In hindsight, was very lucky because eShares, now Carta, we started as eShares, was a much better idea. But after I kind of closed that company and sort of came out of the trough of depression, I was sort of thinking about what to do next. And one of my investors in the previous company, said, "Hey, Henry, you're kind of a finance, guy. Why is it that I can buy, at the time, General Electric stock on E-Trade for $7? Now it's free, but back then it was, trade commissions were going down, and it was about $7. But to invest in two founders in a garage, or to do secondary, in a late stage company, was $20,000 in legal fees, 30 days to close, tons of paperwork. Like it seemed like this obvious dichotomy in the world, this bifurcation of the world. And after kind of wrestling with that question, we decided that our belief was the reason was nobody had built financial infrastructure for private markets. All the financial infrastructure had been built for the public markets after 1933, and all the private market stuff was still kept in contract law, which is why all your securities work in the public world is done by banks, and all your securities work in the private world is done by lawyers. And so the idea for us was, could we build financial infrastructure for private companies that resembled public companies, but on modern technology, not on mainframes, right. Starting from, incorporation, starting when two founders start a company, we'll give them, their cap table and their stock certificates right at the beginning, and then grow with them all the way through the life cycle of the company. And the thesis of sort of doing that was if you could build that financial infrastructure, you could recreate the public markets in the private world, in the private markets, and have liquidity. And we dubbed that the NASDAQ of private markets. But the wedge to get there was we realized, or the insight was, we had to own the cap table. That was the nexus of owning all the future infrastructure we could build on top of it. And that's why we started as a cap table company. But the vision from the Series C deck was always this NASDAQ for private markets infrastructure play.
So you take this idea, which you're excited about, and you start wheeling it up and down Sand Hill Road. My recollection is you get like 40 no's over the course of several weeks. This is a small market. Who cares about cap tables? It's it lives in a spreadsheet today. This has been tried before. I'm curious, sort of that experience would have softened the spines of 99.9% of founders, but instead you're like, no. We just need to go find the right early stage investor for us. I'd love for that experience of in some senses almost self-selection to kind of help guide, some of your thoughts as you advise, founders today when they're trying to find their right early stage partner?
Sure. It was really interesting when I was, this was back in, we did the seed round in 2013 and the A in 2014. And back then, especially in Silicon Valley, fintech really didn't exist. Fintech back then was payments. It was PayPal. That's what fintech was. And we were sort of pitching this capital markets fintech, which Silicon Valley had no experience with. The closest they got to, it was basically in 2013-14, it was photo sharing apps or payments. That's basically what it was. And so I remember one investor asking, hey, is there like a photo sharing component to this stock certificate thing? And they're just like,
no.
So,
that's my stock certificates on Instagram.
Totally, but and we laugh now, but I still get it today. People always ask me, "Hey, is there like a blockchain, component?" And it doesn't sound crazy today, but we'll see, right? In 7 years, we may look back on it. But the interesting thing is like nobody really saw like the capital markets component to it, and the other thing I think that was really tough in Silicon Valley back then was our customer base were other startups, and that's it. And so everybody was like, "How big's the market for this?" It's just you're just selling to other startups. And back then, the only way you got to be a venture backable company was you were a consumer, where you have infinite TAM, or you sold to the Fortune 1000, like your MongoDB or something, right? Where it's like you have a database and you can scale this thing to $1 billion in revenue. But nobody had built a $1 billion business selling to other startups before 2014. And I would give Parker at Zenefits and maybe us credit maybe for being the first two companies solely to sell to startups and get to $1 billion market cap doing that. And now it's like that's where all startups start, right? Is selling to other startups. But that was not true in 2014. Because startups didn't have any money, so they were terrible customers at the time. So anyway, that was the real criticism, and so anybody that did the analysis on Carta, the business school analysis on Carta, said this is a ridiculous idea, and the market doesn't work. And so we were pretty dejected. So we did a Hail Mary, and we went to New York, and I met with 3 firms in New York, and I got 3 term sheets. And it was just a very, they were ahead of the curve on capital markets and fintech, and they could see that fintech could be changing more than just payments. We ended up signing with Union Square Ventures, and they led our Series A. And so it was really just finding in that early stage somebody that wasn't going to do the Excel spreadsheet of the TAM and the discounted cash flow and whatever, but like we just kind of believed that the world was changing, and we were on the front edge of that. And then once you had that fit with an investor, then it worked.
Yeah, you weren't trying to talk them into this, but they really shared the vision of where you wanted to go. We call those our We Believe projects. There's ones that come later, but that's definitely kind of where you were at this point, and that's so great. And I also think it's sort of such good embedded advice for founders to like find that alignment early with your investors, because it's just so critical. So you have this pretty non-obvious, and I actually love the sort of even the name of it concept of what you call, I think, one of N markets versus N of one markets. I'll let you explain what you mean, but I think it would be good for you to sort of talk through how it's played out for Carta, because I think it also ties back to some of this point around fragmentation, selling to startups. But yeah, talk us through one of N versus N of one, and why you have such conviction around one of those.
Yeah, so we play this game, when we enter new markets or kind of build new products, and think about like should we go after this customer type or try to solve this problem or enter this market or space. And we play this game at the executive level where we say, imagine 5 years from now, we didn't do this, but some other startup did, and they came in and they just took over, right? This was like a fragmented market, lots of competition, inefficient, and some startup came in and just wiped everybody out in 60 months. They took 80% market share. They're the dominant player, and everybody's sitting around going, "Holy cow, what happened?" Like,
sounds like Carta.
Totally. And we would just be, what would we say that this company did in hindsight that we missed? And when we play this exercise, all markets kind of have those idiosyncrasies of their own particular market. But the thing that that exercise almost always boils down to three things. So one is the company figured out how to change the market structure of that market to be what we call an N of one market from a one of N market. So one of N market is what we call like a competitive market. You can be one of N players. The market structure allows for multiple competitors to exist. You know, it's a complex enough market. You know, there's no clear solution. There's no economies of scale, et cetera, et cetera.
Yep.
They somehow figure out how to make it an N of one market where there can be only one dominant winner. And the more that person wins, the more they crowd out everybody else. And so they figured that out. Usually it's some business model innovation that they were able to implement that nobody else had figured out. And when we think we think of ourselves as a new market creation company, where we go after things that don't exist yet. We try to make markets that don't exist yet, like the market capital software didn't exist yet. And so how do you define like a new business model or a new market? Our kind of definition tends to be when you figure out how to make money exchange hands in a way that hasn't happened before. So, you know, PayPal, Venmo, like they figure out how to get me to, you know, send you money in a way that I couldn't have done that before.
Well, and the market, in that case, the market emerges as a result of the company's success, right? So again, back to your point around the venture investors who are looking at the TAM as it is today would say, well, that rounds to zero. But your point is, no, if we are successful, it rounds to billions, right?
Exactly. It's really hard to predict because by definition, the market doesn't exist until you make it. And so, you know, we see this, like this company had to have figured out some new business model innovation that's hard to replicate that others have never done before. And then the third is they figured out a really fast customer acquisition strategy. Because if you do make the market structure, you know, N of one market, and you have this new business model that's really enviable, everybody's going to want to come in. So you have to take the market quickly before it fragments.
Exactly.
And so those three things are kind of how we think about this stuff. And if you look at, to your point, Steve, about e-shares, you know, we weren't smart enough to know it ahead of time, but in hindsight, we realized we did this with e-shares. We weren't the first cap table company. We were the first that issued the stock certificate from the company to the investor to make that network. And it was the network of the shareholders with the companies that created this monopolistic or virality, this network effect around Carta that drove our growth and our expansion. So that was one. Two, we changed the business model. All the other cap table companies back then charged the law firms. They were a utility to the law firm that then provided the service. We said, law firm, your money is no good with us. We're going to charge the company. That's it. So our software has always been free to law firms, but we charge the company. And that dramatically expanded the TAM because now, like Cooley, we used to pay our competitors $60,000 a year for a license to manage their 3,000 clients. Cooley now pays us $0, but Cooley customers pay us about $20 million. All we did was change the payer, and the TAM blew up by 100x. You know, and then the third was we used investors as the customer acquisition strategy because the investors would get the stock certificate through Carta. And then in the product, they could then refer more companies to us. And that was the customer acquisition strategy. And so that's like how, so now if you look at our products in fund administration and total compensation, even in Carta X, our liquidity platform, like every product you see, like it has to have those three, all markets have to have those three aspects to it.
You just wheeled us into sort of the next topic that I really, for me, is one of those humbling ones. And it sort of comes from the fact that, so I, you know, started my career in product, was raised in the sort of, you know, Silicon Valley best idea wins culture, you know, Stanford and IDEO. And then I sort of realized a few projects into my career, initially as an engineer, that there was this sort of other thing, distribution, that nobody actually told you about, right? Like, you're like, what the hell is distribution? That turned out to be way, way more important. And what you just described around, for example, flipping the business model to selling to the companies versus the law firms, or even more specifically, the network effects and the gravity that you created around this product, you know, in this context of N of one. Talk more about, like, I mean, you think about distribution as like the most important weapon, even though you have a great product too. What is this? How does this play out played out for you guys? And then also, how does it inform some of the advice that you give, founders like the ones that are, on this Zoom now, where they're thinking about like, I'm going to throw all my efforts at product, or how do I think about kind of the right time to light up distribution?
Yeah. Well, and it makes total sense, Steve. And I'm a product founder, product first founder too. And it makes sense that we highlight product first founders, because if you're starting from nothing, it has to be product first, right? It's an inventive problem because you have no distribution. And so you start with product, hopefully a 10x better product that has incredible product market fit, that's new and novel, and it has such strong product market fit that you get distribution almost for free, right? It's like Mark Andreessen's thing. It's just the market pulls the product out of you.
Right.
I remember in the early days, we switched our phone service, to like RingCentral or something. It wasn't RingCentral, but something like that. And I remember our phone system would hang up on you if you pressed 1 for sales for a month, and we didn't even know it. We were still getting so many orders through the online, and that's product market fit. It forgives so many problems, so many dysfunctions of an early stage company. The problem is, I liken it to being a singer. I'm not a musician at all, but I can imagine like you're a singer, songwriter, musician, and you put out a great song, and we know all those one-hit wonders, right? Like they put out a great song and you never heard from them again, because it's really hard to do one great platinum song, top Billboard song. But it's really, really hard to be the Rolling Stones or U2 or Coldplay and just do it year after year after year. That's really hard. And it's really hard, even for product founders, to just consistently, put out amazing products that the world wants. Like, it's really, really tough. And so one of the amazing lucky things of founders is if you do get the opportunity to get that one product to market, and then you build the distribution pipes. Many might be one-hit wonders, and they're just sort of done. And you these single product companies that scale out, they become $2 billion, market cap companies, and just kind of sit there.
Yep. But
the ones that keep going are ones that then say, okay, how do I then use those distributions to sell more product? Even if it's not an amazing product, it's got marginal product market fit, because I have distribution, I can actually learn faster, execute better, push this product in. I can now use corp dev as a weapon, right? I can find other products that have product market fit but don't have distribution. I can pick them up and put them through my pipes, right? That's the Salesforce has done that better than anybody.
It brings up the point, and this is something I wrote a book around, sort of the product design and the way to design a few years ago. And one of the things that I sort of really struggle with in the Valley culture is this concept of product market fit as this sort of 0 to 1 moment. Because as you say, it is a liquid, not a solid, right? You achieve product market fit, and that kind of gives you your opportunity or your license to kind of go get started. But look, the competitive landscape changes. Your customers want more. Competitors catch up with you. New technology affords new features and functionality. So you've got to kind of build your org around like product market fit is this continuous thing, right? It is much more of a journey rather than a destination. And I think your point as well here is that distribution integrated into the product, like this, more similarly to sort of the way even open source projects are built, where the community and the product co-evolve. And you've kind of created this product where the network effects and the product are growing together. And, then as you own that socket, as the sort of, the gravity of your product in an N of 1, as you own that socket, now you can start to jam more and more products through into that, through that distribution network. Which just feels so good. And by the way, I don't think many companies think very strategically around distribution as you are.
Yeah, well, thank you. It's and it's hard because you have these, there's like these kind of transition stages, like from I'm working on a product and now I'm selling the product, right? Like that's always the launch, transition. But now it's okay. Now my product it's got fit and it's like growing and I'm scaling and I'm acquiring customers. And then there's this transition of becoming a single product to a multi-product company.
Yep.
Like, what do I do with my second product? How do I sell that product? How do I not confuse my customers when I sell that product? How do I manage, a large sales force that's selling multiple products? Then it becomes this question of, okay, well, what if now I have different buyers? So it's actually a different customer, even if it's the same company I'm selling to, but different buyers within the organization. So I become a multi-product / multi-customer or multi-buyer persona company. And these are all inflection points in the growth or life cycle of a software company. And many companies stop at one product, one customer. Many stop at multi-product, one customer. The best companies will be multi-product, multi-customer.
Exactly. Yep. There's a good question that Bombardier asked over in the comments, and I'll weave it in because I think it hits on this point you just brought up, which was, which stage companies were the most challenging for Carta in its early days? And I think it does get to this question of how many products and how many customer types. And you guys, one of the challenges with the kind of like, many products through the same distribution network is it can be very defocusing, right? Like your team sort of feels like, Henry, what do I focus on next? Are we really supposed to be doing just, cap table management? And I also remember when you acquired SVB's analytics business, there were, people kind of scratching their heads going, wait, what are you doing acquiring this unloved service business around sort of 409 valuations and analytics? But I'd love for you to kind of talk about kind of how you still manage discipline of flexibility versus focus when you have that kind of many product approach, and kind of when you can go from one product or two products to many more.
Yeah, so I might be a little bit on the contrarian side on this, but we launched cap tables in January 2014, and then we launched our first 409A product in April of 2014. And then we launched our investor product in December of 2014. And so we already were trying to be and 409A was at least the same customer. Investor was a completely different customer. And so we went all the way to multi-product, multi-customer super quickly. And part of it was because I had been scarred with this, hey, how big is the market for cap tables? And so we still to this day, we still always have this paranoia. Any market we're in, we'll run out of oxygen. And so we constantly have to, find new markets to go into. But the other thing is that I'm an obsessive student of org design, and I think this idea of like focus, venture cap, a lot of venture board members will say like focus, and that's because they have a portfolio of companies, and so they already have their bets spread, but they're like execute on one thing. This is what I invested in, and so on. Obviously, as a founder, I want to diversify within my portfolio of products. And the way to do that is by creating an org chart designed by BUs. So we had BUs within, by the time we were 30 people, we already had a BU model or BU org design within, and so they could all focus on their own paths. And I viewed myself, even at 30, 50 people when we were tiny, as a portfolio manager of these different products or businesses that we were placing bets on, and each had like a GM that was responsible for driving this business. They were mini CEOs. And I think that really worked. I'm not saying it's that every company finds its own path, but for us that very early on wanted to place a lot of bets on the roulette wheel, that worked out very well. And we kept a BU model for 4 years until we moved into a more functional model.
Okay, that's where you are today, more functionally oriented. The other thing that I think is embedded in, for example, some of the products that you or some of the former services that you decided to productize was the sort of, almost the Paul Graham, do things that don't scale, be willing to kind of like, treat things manually, figure out how you can automate them. Again, sort of services that were, until you existed, done inside of, law offices with a time and materials business model. Do you feel like you've kind of figured out a way to kind of take services and turn them into products that maybe others can learn from?
Yeah, so we, another way of thinking about our cap table business is we went to market. So before eShares, cap tables was a services business where you emailed your paralegal and you got a spreadsheet back, 3 days later, and it was all manually done. And we said to the market, we're going to take your cap table and we're going to put it in the cloud and we're going to make it real time. And that was the value proposition. That's it. And so we did that. And we turned the services business into a software business and had very strong product market fit. Then we said to the 409A, in 2014, people probably don't remember this, a lot of young founders, but back then it was the same thing. You emailed your analyst and 2 weeks later, they'd email you a report and, it'd be like, all hand done. And we said, we're gonna put all the math in the cloud and we're gonna make it real time where you can just hit a button and we'll generate the report for you in the calculations. And it had incredible product market fit. And we turned the services business into a software business. In 2018, we did the same thing for venture funds. We said, hey, we're going to manage your schedule of investments. Right now, you email your accountant at the end of the quarter, and 2 weeks later, you get a spreadsheet of your SOI. Yep. We're going to make it real time. We're going to put it in the cloud and make it real time. And that business we launched in 2018. It went from 0 to 50 million in ARR in 32 months. And that, great resonation. And so we love entering services businesses that sell a commodity, right? Like an income statement, and an income statement is an income statement. If you get it right, it's not like one income statement's better than another one. It's either right or it's wrong. We love entering commodity services businesses differentiated only by brand, where we can turn it into a software business. And then it really also lends itself to a strong M&A playbook. To your point about SBB Analytics, we can buy a services firm like SB Analytics. We can pay services revenue multiples, and then we pull it into our business, put them on the software, and now we trade. We can buy it at 3x ARR or revenue, and we trade at 30. Yeah,
or 30. Yeah, there you go.
Yeah. So we love that services to software arbitrage.
Yes, makes sense. Question from Jane, which I think relates to something you were talking about a few minutes ago, which was sort of around your distribution aha moment. And I think you talked a little bit about like where to, how to charge which party and kind of where to go fishing for your next leads. Can you talk through that a little bit more? So I think it kind of ties back to your sort of, going and embedding yourselves into kind of every venture firm. Like, I think about how many of my portfolio companies, I think it's probably 90-something% are on Carta and have been on Carta since it was eShares. But I'd love for you to kind of like talk a little bit more about like when you thought about, okay, no, we're going to actually sort of flip the model and charge this, this party for this part of the product, and even maybe a little bit of the secrets around price discrimination, because I know you charge us more than you charge the companies.
Yeah. What's interesting in the early days, it was really, I feel so lucky, I would say like, of our success, 90% was luck, 10% was taking advantage of it. We were so lucky. So one of the things that was really lucky about us, is that back then, nobody sold to startups. And today, if Steve, you invest in a B2B SaaS company, I'm sure that the founder is like, hey, introduce me to all your portfolio companies. But all of your portfolio companies are doing that too. And you're like, oh my God, and I'm getting inbound from all of my investors with 50 different apps, but back in 2014, nobody did that because, like I said, nobody sold to startups. We were the first. And so if you were an investor, even if you didn't invest in eShares, and I was like, hey, I have this cap table software, I think it would help your founders. I can give you a foundation capital discount. Would you just tell them about me? You were thrilled to help, right? Because you could be helpful to your founder, give them a discount, help another founder. You just pay it forward. Just be a nice, good citizen of the ecosystem. And so we got so much help from investors, and that arbitrage was how we got started. Was all the investors really rallied around helping us get off the ground and getting us customers. And it was through that we learned how to price, we learned what our product market fit is, we learned the roadmap. We just got a lot of early help. Now it's harder. All marketing is an arbitrage, sort of by definition, because once you discover a gap in the market to go fill,
everybody sees it. It's not a secret anymore.
It's harder. It's harder now for founders. You have to find more creative ways. You can't just rely on your investors to be your salespeople anymore.
Yep. Very cool. One of the things, Jane, you asked sort of about my sort of some thoughts on distribution, discovery, and experimentation. I think just building upon what Henry was just saying, I think one of the things I've observed, and this sort of was a not obvious to me as when I was designing products or just designing products early in my career, was to think about distribution and bluntly also business model as part of the design space. In other words, oftentimes people sort of design the product just with the user experience or the technology in mind, but don't actually think about business model as a product challenge, right? Like, so it's kind of like, or as my friend Diego likes to say, designing without a business model is kind of like building a bridge without thinking of gravity, right? So if you can't think about that as a design problem, to build your distribution into the product, so it's kind of woven in the way Henry talked about network effects as fundamental to the product, I think that's probably the big aha for me is not treating these as sort of siloed activities in your company where you finish the product and chuck it over to marketing, but rather you kind of weave them together in a much more intelligent way. So you said, Henry, you're a student of organizations and organizational design. This is something I'm fascinated by as well. And when I think about whether it's Bezos or Steve Jobs or way back days of Gordon Moore or Ken Olsen at DEC, it's absolutely the case that the bias of history favors startups that are run by their founders as long as humanly possible, right? Like we saw this over and over again. Jobs coming back in '97 was such a stark example. But the thing about this is it actually requires you, like the founders, to learn and grow and scale as fast as your business is. I think if you could share some of the ways that you, as Henry, have grown and scaled as a leader, and how you advise founders who are trying to do the same while their businesses are growing non-linearly. Like it's kind of hard to grow non-linearly as a human, right? Like our biology is quite literally not designed for that. But you've figured out some hacks that I'd love for you to share with our folks, and the more honest and raw, the better.
Yeah. Well, I'd say one thing, just the caveat, at least for me, my experience is no matter what I do, I always don't feel like I'm very good at my job because sort of, but by definition, by the time I get good at something, I then delegate it to somebody else, and
Exactly.
I have to learn something new. And so you just kind of get, I would say the first thing for me is just kind of accept you're on this treadmill of like always like learning and not being great at what you do. It's the luxury of like, hey, I learned a skill and now I do this thing and now I get paid to do this thing. That's not a founder career. That's not how it works here. It's always changing. I think the thing that I think a lot about is how do I add value to my execs or to the people that report to me, and that's the directional North Star. And I don't say that like in this like, oh, I just want to be valuable, all this kind of stuff. It's actually a really hard problem, and the reason is I say this to execs when I coach execs on stuff. I say, hey, what's the difference in your career? You've been 20 years, and now you're CFO. You're my CFO, let's say. What's different about working for the CEO than working for anybody else in your long and storied successful career? And they'll say, oh, you strategy, all this kind of stuff. And I always say, oh, that's true. But the real thing is, it's the first time in your career that you work for somebody that's worse at your job than you are. Like, your whole career, like everybody above you is like the reason you work for them because they were really good at what you did. And now it must be so disappointing. You spent 20 years to get to be working in the C-suite, to get to work directly for the CEO, and then you realize he's an idiot. Like, he has no idea what you do or how to help. When my CFO comes to me and he's showing me like margin profiles, I'm like, what are you talking about? I don't know.
I have no answer for you.
Yeah, exactly. Like you can't come to me for help. You can't ask me questions. Like you're working for a bozo. And so the question is, okay, well, how do I add value to, a guy or gal that, is in the top of his or her field, in a field I know nothing about. And that is a really hard problem for my, picking on my CFO to do it for my CFO. And then how do I do it for the chief product officer, the chief technology officer, the chief people officer? Like I got 9 of these people that I then have to figure out why they would want to talk to me and what I can do for them. And it's really hard. You have to learn a whole set of things. And a lot of it's around context, right? And understanding all parts of the business and being able to frame things in ways that are that they can get their job done better because they understand other parts of the business, right? That's like the secret power that a CEO has, is that we have an aperture that nobody else has. And so how do I take advantage of that aperture? And sometimes it's just knowledge. Oftentimes it's I've done work in something and I've gone deep in another area and I can be an expert there, but it's so dynamic, right? And so that I would say that the North Star that I always use is like, oh, I got a one-on-one with my CFO or my head of people next week. what can I do leading up to that I could be helpful to them, that they just don't walk away going, I'm working for a bozo again.
Yes.
Right? It's really hard to keep up with these people.
Well, you're reminding me of, about 6 or so months ago, I interviewed Reed Hastings as he was launching his No Rules Rules book. And one of the kind of core insights from, I would say, the Netflix culture and Reed personally is this concept of context, not control. And, you know, they even get so specific around, like, when you see a project fail, go back and really investigate how much context was really set. And oftentimes what you discover, it wasn't that some junior person, you know, was an idiot and wasn't, you know, didn't have their head kind of turned on right, but rather that the context, the sort of what were we really trying to build for whom, was still not clear. And so that sort of cross-pollination component of your job sounds like is a P0 for you, and you've really gotten intentional about that. What else about how you have gotten better personally? Like what are some of the things where, you know, whether it's coaching or, you know, when I think about Lynn Jurich at Sunrun, like, you know, she had never managed anyone until she, you know, had started Sunrun, and is, you know, CEO of a public company, and just watched her continue to grow with this sort of voracious intensity. But like, how are you continuing to grow and evolve as a leader?
Yeah, well, my current, I would say I've two things that I've been really working on. One is to something that you said about context, which is this mantra I've been having, which is like, everybody's right, everybody's correct when we have disagreements. This is a question of aperture. And so how do I see, you know, we're 1,500 people now. There's a lot of apertures now to consider. And so how do I see everybody else's aperture? And these apertures are complex and nuanced. And I have my aperture, but my aperture, you know, is not, you know, I don't get to see all the stuff on the ground anymore. So I've been really trying to be flexibly minded about how do I see the world in other people's eyes. Yeah. So that's been a really big one. Which leads into my second one. And this is something that Mark Andreessen, I think I think it was like after he invested, it was like my second breakfast with him or something like that. And it was really helpful. He like pulls up his napkin and writes on a piece of paper, he draws this line. And on one end, he goes, it's like maniac. And then on the one end of the spectrum, and then it was like impulsive. And then on the other end, it was like rigid, and then sort of like strict. And then in the middle, he put like question mark. And he goes, this is a spectrum of founders. You know, we have them from like the maniac founders, you know, like Musk and everything. And then, you know, the rigid founders like the CEO of HP that don't change anything. And he's like, you, like many product vision founders, are on the maniac end of this thing.
Thank you, Mark.
Yeah. And he goes, look, you don't want to be a rigid. Like, we want you innovating, but you're at a scale now where we want you more in the middle, because the job is not you just doing whatever idea you have next. He goes, I don't know what the right word is for the middle, but he goes, the best way I can describe it is like a systems thinker.
Yes.
So can you build the systems that will build the company, not you build the company? And that really stuck with me. And so like I have this framework now, like, you know, when people come to me and I have to make a decision, I immediately think, what went wrong in the organizational framework that I put in place that I made the decision versus the organization couldn't make its own decision because I had the frameworks in place. And so everything, it used to be when you're an early stage founder, it's a very narcissistic role. You're like, everything comes through me. I make all the decisions. I do everything. And my kind of where I am now is like, look, my job is actually to build an organization that can self-govern without me being in the middle. And that's what I'm working on these days. So
I love that. It reminds me of a conversation I had with Joe Gebbia a few years ago, and he thinks also in systems. And if folks in the audience have never found Donella Meadows, she's sort of, in my opinion, sort of 0,0 for great systems design. And by the way, this is thinking literally that's 30, 40, 50 years old, but I think has become even more important. And you describe it as well as sort of like, when you really do understand systems design, you can see, particularly when you have this horizontal view that you as the CEO have, an ability to kind of make a small adjustment in one part of the system and see a huge renovation in another area. And that power is, and the leverage of that is just absolutely incredible. By the way, the word, I worked with Mark for 2.5 years, but the word I would have thought in the center would have been curious, which I think is related to, sort of systems design and really trying to understand the underlying connections as opposed to just the symptoms. Henry, I'd love to hit on one other thing related actually to your sort of board and interactions with your investors. You figured out some pretty clever ways to put your board to work, not just sort of like in between board meetings, but like inside the company. I don't think many founders and CEOs take advantage of their boards enough. I push my CEOs on this all the time, and not just sort of in easy ways. But I'd love for you to share some of the ways that you're kind of actually making your board work inside the company.
Yeah, sure. So since we moved last year, we moved to a functional model. But when we ran BUs, we had a program for many years with the board called Adopt a BU. So each board member would adopt, a BU. Each BU had its own management team that kind of reported to me. But they, semi-autonomous. You basically got a budget and some goals, and they kind of did their thing. But I would have the board adopt a BU, and each board member would be assigned a BU, and they would work directly with that BU, and they'd be sort of like a mini board for that BU, and it was great for a lot of reasons. One is that the teams loved exposure to the board, they loved working with one of the board members. I'm sure team executives would love working with you, Steve, kind of thing. Board members, I think founders don't realize a lot of that job is boring. It's like sitting and eating, governance, I think there's
drinking water.
It's the worst, right? And a lot of board members, a lot of investors, former operators that kind of miss a little bit of it, right? And so the fact that they can roll up their sleeves and work on strategy and, work with execs and, talk about stuff, they get really excited. And then it takes a bunch of pressure off me, because now the board members are getting direct information. I don't have to update them on everything. In fact, they're updating me. So when we go to the board meetings, I'm like, how's the corporation's BU looking?
And there's also a confidence around that it allows you, I think, to let your board members have the honest conversations where they're like, oh shit, I actually realize we have a problem over here. And then let's, rather than wait for it to kind of bubble up to you and then to the board, you can kind of have these conversations more constructively and proactively. But again, I think most entrepreneurs are not taking enough advantage of some of the insight and the connections in the network. I'd love to, in the last couple of minutes, there's a question that Kirsten asked. I think it's probably one many of us are curious about, although I know you're kind of spending 150% of your time in the foxhole, but when you think about kind of where fintech is today, and kind of when you had that sort of aha moment, oh shit, nobody understands fintech beyond, call it payments and maybe lending back in 2013. But what are some of the neighborhoods and themes you're most excited about? Maybe it's actually things that you'll throw Carta at over the coming years. But what are some of the things that get you excited? I haven't seen you're not planning to rename your company with another dimension to go from a square to a block. But is there crypto in your future? How do you think about some of the things that other folks are getting excited about, whether it's Web3 or DeFi or anything that's out on the horizon for you?
Yeah, well, we're obviously watching crypto and looking at that space really, really closely. We're not sure quite how it intersects with us yet, but we're watching it really closely, especially DAOs, because we believe in governance. I think what I find personally really fascinating and interesting is COVID has definitely accelerated the globalization. So you're seeing, for example, all these payroll companies Deal and all these Panther and all these payroll companies, global payroll companies. And obviously we view equity as payment equity. It's like Coinbase is pay me in Bitcoin, so now you can do payroll through Coinbase. We kind of believe equity is going to be a payroll item, I hope, for everybody soon over the next 10 or 20 years. And so that's just, I think the globalization of finance is, borders are just going to start coming down more and more. Yes. And so, I think Bitcoin, crypto is one version of globalization, but I think there's, there's so many other opportunities to how to do globalization of finance. have currency flows move much more seamlessly. Like it's today, if I want to invest in a London-based company, like it's really painful. Like it's hard to do to invest on the LSE. I think 5-10 years from now, like that shouldn't be a thing, right? Like somebody will figure those types of things out. So I'm a big believer in the globalization of finance. I think also liquidity reaching new markets will be a big theme. Again, that may be a crypto thing, but I don't think it's just crypto. I think it's more broadly like, we have a marketplace as a service product where, you can, think like Amazon Web Service, but anybody could, instead of firing up a server, you can fire up a marketplace. Like that's kind of our idea. So, everything from we do derivatives trading in Hong Kong to, rice and oil, water rights in Australia and rice paddies in Myanmar, hopefully, and so like that concept of bringing technology into liquidity. I think NASDAQ and NYSE is just like that. It's been very old. Like that's the only kind of form of exchange in the United States. Like there should be many, many more marketplaces. So I think, consumer has touched it with Etsy and eBay, like all that kind of stuff. Yes. Really hasn't hit the financial space yet. So I think liquidity is going to be a big one.
I feel like that sort of point on the horizon that you had back in 2013 of NASDAQ for startups, what's so powerful about it is it's still there, right? Like it's there for you to go drive the team toward, and you've obviously accomplished so much, but still, so far to go to deliver on that. And so much potential. Henry, I know we're past time. On behalf of just everyone here, thank you. What a great set of insights and observations. Many of them non-obvious. I'm sure folks are not hearing these anywhere else, including at other panels at the conference here. But yeah, I'm just so grateful for the time and the insight, and thank you. And I'm going to be getting you one of those bottles of Foundation whiskey here. In the next,
Thanks so much, Steve. Thank you, everybody. This was a lot of fun. Thank you.
Awesome.
Okay, great. Thank you, everybody.